We've seen the NIC 20, which gained 37% in 2010, dropping roughly 12% year to date. To what extent are we seeing the market merely correcting on the back of the kind of rally that we saw last year?
Well, I still think it's a correction. We have come from that very good increase in 2010, and of course we believe that there are a lot of stocks that investors may feel have peaked. The other thing is that we have had so many pressures on the Nairobi Stock Exchange, which include inflation. We had the flight of foreign investors from the African markets during the Egyptian crisis. We have seen them start trickling back, which has been a good thing for us. We've started to see a bit of recovery on the foreign investor front. We're going into an IPO window, which means that will also excite the market, especially for local investors who usually have a tendency to get back into the market in a strong way whenever we have an IPO. We saw quite a few rights issues bring that excitement last year. This year we expect that the IPOs that are lined up for the year will probably bring that sort of excitement.
Well, taking a look at the kind of news that's keeping the markets busy, it's primarily on the results front, and a big one that filtered through after the closing bell yesterday, that of Safaricom, largely, as I said earlier, in line with expectations. Your overall impressions there?
Well, they have proven that diversification of products is the way to go. I think they still have done quite well compared to some of their peers. I believe that it was expected that voice-generated revenues were going to go down, especially having seen huge cuts in voice tariffs, and I think they are also very clear about where they expect average revenue per user to sort of settle at. I think they said around 100, and that is actually a very realistic way to go about it. But we have seen their non-voice revenues growing at 50+%, their data, their M-Pesa, and these are really helping to show up and to give them the sort of support that Safaricom needed in order to overcome the shocks that were coming from the mobile telephone sector.
So where we saw that dip back on the share price yesterday to about the 3 shilling 90 mark, what are you anticipating in terms of price action today?
Well, Safaricom, I was actually quite looking at what they would pay in terms of dividend, because Kenyan investors are very, very keen on what they get as a dividend. And for the big investors, the dividend has been held at the 20 cents per share, which is over 5, almost 6% dividend yield, which is a very good dividend yield compared to compared to the market. And I believe that should excite a lot of investors. But the big issue is that Safaricom has a very big chunk of investors who hold a very small amount of shares, say 1,000 shares. And those are the investors who usually feel that the dividend usually costs more, the check costs more to cash than the actual dividend, and they end up having trouble at their annual general meeting. But I think a dividend yield of 6% or around 6% is quite healthy, and that should excite the market.
We'll be monitoring that share price movement through the course of today's trading session. Another company out with numbers yesterday, Standard Chartered Bank. It had a high turnover of 19 million shillings after releasing its first quarter numbers, which showed a 13.8% year-on-year increase in profit after tax. What did you make of that set of numbers within the banking space, where we've seen some of the other players, Equity Bank, Cooperative and KCB, really outshine?
Well, I've always held my opinion that Standard Chartered and Barclays Bank are very conservative. And when we are, although we have just entered into a slight bearish period or a short period where we have seen the markets, inflation and all these pressures, we are still coming out of a very bullish 2010. And usually in a bullish year, you find that the ones that make the big earnings are usually the ones that have gone out to the unbanked population, the banks that have gone to continued with their expansion strategy, etc. Now with Barclays and Standard Chartered, we have found that they have been very conservative. They have tried to remain with their niche markets, and so at 20%, you know, around 20% means that they are still earning on that conservative level. You will find that they have earned quite a lot on the non-interest income, and I think that was coming from the fact that they bought Barclays custodial services, and I believe that they are trying to manage their costs, but basically I still believe that in a market which is seeing a lot of expansion, they being conservative will tend to weigh down on their growth.
Do you see a shift in strategy coming to the fore from their end at all, Samuel? Because right now we've got corporate loans dominating the bank's loan book, and of course this is a bank focusing on its corporate clients more so and its middle to high income retail market. Are you anticipating any shift whatsoever in order to leverage off the kind of economic growth that we're seeing filtered through from Kenya?
No, I'm not with Standard Chartered. We have seen Barclays Bank move from being aggressive to being conservative to being aggressive. Now they have started another aggressive campaign, and I think that plays against them because people wonder whether they're going to be there when things go wrong, and I think that is not a very good strategy to take. I think the consistency is important, and Standard Chartered has been very consistent. During the bullish period, they remained very conservative. A few years ago, when we saw banks like Equity make huge gains, then during the bearish period, they were the best performing bank because they remained with their niche, in their niche area, and remained as conservative as they've always been. And right now, they are still where they were. They are not changing their strategy, and I think that consistency actually plays out very well for them, because then you have a sort of feeling of stability, a feeling where you know that one way or the other they will still keep their market.
Well, we're going to have to keep an eye on Barclays as well, because a lot of market watchers out there saying that the bank's strategy is not clear enough, that they're looking to see a clear strategy coming through from Barclays Kenya moving forward. We have seen this bank, though, laying off about 5% of its workforce in an effort to rein in costs and support profit growth. Staff costs with this first quarter set of numbers for Barclays fell to 238 million, fell 238 million shillings to 1.8 billion. Is that the end of the cost-cutting, avenue for Barclays at this stage?
Well, possibly. I don't think it will be a very positive picture when they do too much of that. And seeing that they've started being aggressive again in terms of bringing out their mortgage loans, we've seen them quite a bit on television, and the advertising spend should go up this quarter. I believe that they are looking now to expand, and I think the layoffs were more for a restructuring process, and so they should, I believe, have sorted that out and now moved on and sort of focused on what they want going forward.
Well, very quickly, Kenya Commercial Bank has restructured its management team with immediate effect following recommendations by international consultancy firm McKinsey & Company. To what extent and what is the market made of the kind of streamlining that's happening within that organization?
Well, personally, I feel it's a very good thing. Kenya Commercial Bank was originally a banking, a government-owned, and had a very heavy, their management structures were not very efficient. And I think that is the way to go for them. I think if they're going to be able to compete in the current environment, then they need a leaner and more efficient, and the decision structures need to be made much faster.